Buying a company's stock is one of the oldest and simplest investments in the business world. In short, when you're buying a stock, you're making an investment in a company. If that company performs well and grows, the demand for their stock will go up, and so will the stock price too. And you can then make money by selling the stock or collecting benefits like dividends. Anyone can buy stock, which makes it accessible for even the most unskilled of investors. In order to understand what stocks are and how you can make money with them, let's break it down. Today, we are bringing you everything there is to know about stocks. Let's see what they are and how they are bought and sold. And the most important question, how can you make money trading stocks? So let's get started. What are stocks? Stocks are effectively shares of ownership of a company. If you own enough stock, let's say 5 to 10% of total shares, you'd have significant influence on how that company is run. However, most people own just 1 to 10 shares of a company, and you would still have an influence, but your votes on important decisions will be less of the total votes, so it doesn't matter as much. Most stocks sold on the open market for individual companies give you the right to vote in shareholder meetings. This means you can vote who is on a company's board, whether they acquire a certain company, and so on. But this is not what stocks are usually bought and sold for. Why and how are stocks bought and sold? Simply put, the main purpose of buying and selling stocks is to make money. Investors buy and own a stock in order to make a return on their investment. You can buy a stock whenever you want and also sell it whenever you want, as long as there's a buyer and a seller willing to take you up on the other side of the deal. Most of the time, you aren't buying from the company directly either, but rather, you're buying from another stockholder who wants to sell their position. Companies initially sell their stock in something called an initial public offering, or through other public offerings after the fact. These allow companies to raise money without having to take out a loan. So, how do you make money with stocks? There are 2 primary ways in which you can make a profit trading stocks. For one, the stock appreciates. In other words, people are willing to buy that stock for more money than what you paid for. If the company makes great decisions and turns a profit, more and more people would want to own their stock to make money with them. This increase in demand drives the price up. Assuming the total number of stocks on the market stays the same, this is simple supply and demand. Stocks can appreciate for any reason, and their value is tied to a number of factors that don't always tie back to just how much money that company makes. Since stocks are sold on an open market through an exchange, their price is more a reflection of buyer sentiment or how good or bad people think the company will do. Stocks for companies that lose millions of dollars each year can go up in price if the market thinks that they will be more and more successful very soon. The second way that you can make money by owning stocks is through something called dividends. Some stocks, but not all, pay dividends. Dividends are payments directly from the company made to shareholders that come from the company's profits. Think of this as a way to entice people to buy a company's stock and hold on to it. Dividends are paid quarterly, and the amounts vary by company, but it's usually a set amount for each company for each share that you own. Companies would want to pay you a dividend so that you hold their stock and don't sell it. Supply and demand means this will drive the price up over time. Companies want their stocks to go up so that the shares that they still own are more valuable, as well as so that any shares they decide to sell or offer in the future can be sold for more money, generating more investment money for them. Now we've explained what stocks are, how they work, and how you can make money. So now it's time to ask the important question that you're all here for. How do you invest in stocks? There are 5 simple steps that, if you follow them, you can be a successful investor. Number 1, define your tolerance for risk. Risk in investing means that there is a chance you could lose money. Stocks are categorized in various ways, such as large capitalization stocks, small cap stocks, aggressive growth stocks, and value stocks. They all have different levels of risk. Once you determine your risk tolerance, you can set your investment sights on the stocks that complement it. Number 2, decide on your investment goals. When opening a brokerage account, an online broker will usually ask you about your investment goals and the level of risk that you're willing to take. Your investment goals can range from buying a house, funding your retirement, saving for tuition, or just increasing the amount of money in your account. Either way, it's important to decide what your goal is. Number 3, determine your investment style. Some investors want to take an active hand in managing their investments, while others prefer to set it and forget it. Your preference may change, but decide on an approach to get started. If you're confident about your investing knowledge and capability, you could manage your investing in portfolio on your own. On the other hand, an experienced broker or financial advisor can help you make your investment decisions, monitor your portfolio, and make changes to it. This is a good option for beginners who understand the importance of investing, but may want an expert to help them do it. There is also the option of a robo-advisor, an automated option that usually costs less than working with a broker or financial advisor. Once this robo-advisor has your goals, risk tolerance level, and other details, it automatically invests for you. Number 4, choose your investment account. You can choose from a retirement plan at work, such as a 401k if your employer has one. Once you enroll in a plan, contributions are made automatically at a level you set. Employers may make matching contributions on your behalf. There is also an IRA or taxable account at a brokerage, or the robo-advisor account we mentioned just earlier. Number 5, learn to diversify and reduce risk. Diversification is an important investment concept to understand. In a nutshell, by investing in a range of assets or diversifying, you reduce the risk that one investment's performance can severely hurt the return of your overall investment portfolio. You could think of it as a financial jargon for not putting all of your eggs in one basket. While it's important to follow these 5 steps when investing in stocks, there are other things to consider too. For example, many financial institutions have minimum deposit requirements. In other words, they won't accept your account application unless you deposit a certain amount of money. There are also certain costs that occur when investing in stocks, such as commissions and fees. Remember, all brokers have to make money from their customers in one way or another. In most cases, your broker will charge a commission every time that you trade stocks, whether you buy or sell. Trading fees range from $2 per trade to as high as $10. Some brokers charge no trade commissions at all, but they make up for it with other fees. Depending on how often you trade, these fees can add up, affect your portfolio's return, and deplete the amount of money you have to invest. But people new to investing who wish to gain experience investing without risking their money in the process may find that a stock market simulator is a valuable tool. There are a wide variety of trading simulators available, including those with and without fees. Stock market simulators offer users imaginary, virtual money to invest in our portfolio of stocks, options, ETFs, or other securities. These simulators typically track price movements of investments and, depending on the simulator, other notable considerations such as trading fees or dividend payouts. Investors make virtual trades as if they are investing with real money. Through this process, simulator users have the opportunity to learn about investing and to experience the consequences of their virtual investment decisions without putting their own money on the line. Some simulators even allow users to compete against other participants, providing an additional incentive to invest thoughtfully. Are stocks an investment you would consider making? Have you ever tried a market simulator before? Let us know your thoughts in the comment section below. And if you enjoy this type of content and want to learn more about the financial instruments and investment opportunities out there, make sure to subscribe to our channel and click the bell icon so that you're notified every time we post something new. Thanks for watching, and we will see you again in our next video.